Hi, ladies and gentlemen, this is Steve Harney. I'm the founder of KCM, and hopefully you've been on the last couple of deep dives, so you already know who I am. One thing I want to get straightened out right from the beginning. Somebody's already asked me, do you only have black shirts? No, this is kind of my shirt for the deep dives. As you know, the logos and everything are black with white, so I wear the black shirts. One of the people here at KCM asked me to put one of those big helmets on that you see in the logo. Well, I'm not going to do that. So you're just going to have to deal with the black shirts. All right. And that's as far as that's concerned. Just before we get started this morning, has anyone, I know sometimes people ask questions up front, hoping to understand, what we're going to be covering today or what they hope we're going to be covering today. Before Jess asks me the questions, understand there's three possible answers. Number one, I'm going to say, I have no idea, but I'll try to get the information for you and get it back to you. Number two possibility, will be that we're about to cover it here. And if we're about to cover it here, I'm just going to ask you to be patient and wait for the slides so we can really get into a deep answer to that question. And number three, it might be something we're going to be covering in the future, and I'll let you know that. All right, but go ahead, Jess. Shoot.
Awesome. Thank you for that, Steve. We did get a few questions that came in.
Okay, cool.
So one of them is about alternative lending. A member asked, how many assumable loans are there out there? It's been a while since assumable mortgages were popular, but now seems like a ripe time, maybe overdue to understand more about them.
That's really weird. We're not going to cover that today. We're going to cover mortgage rates today and what impact it has on the business. But I will let you know that 2 weeks from today, which I think is August 21st, we're doing a whole deep dive on alternative financing. We're going to be talking about assumable loans. We're going to talk about why are there so many cash sales? Where is that cash coming from? We'll talk about buy downs, and is there still a market for buy downs, and what does that mean? And we'll talk also about, and this is scary, I'm going to say this, but adjustable rate mortgages. And we're not talking about your mother's arms, from 2008. There's some programs right now that really make a lot of sense for some buyers. So we're going to devote a whole half hour to that alternative financing. And we've already done a lot of research, and I've been shocked about how much it's being used, and it's starting to really take on. So that's why we're doing a deep dive on it. And I'm going to be in Dallas that day. I'm hoping I can grab one of my mortgage friends from down in Dallas, and maybe he could come on and help us a little bit with some of the explanations. But we will be doing that at August 21st, not today. Today, we're just going to cover rates and its impact on the market.
Awesome. But that information is coming. I know people will be excited for that one.
I'm excited.
We did get, yeah, me too. We did get one more question from a member, Cindy, about defaults. She asked, what's the expectation for foreclosure rates?
This seems to be a question that a lot of agents are having right now, because there's a lot of misinformation out there. We've done an extensive research on that, and it's kind of weird. The agents are really on top of what's important, because next week, August 14th, we're doing a whole half hour on the foreclosure crisis, ? What's really going to happen? I think it's all news that people are going to like to hear. But again, we're going to do a full half hour on it. We're going to break down foreclosure rates. We're going to break down delinquency rates. We're going to break down any single thing. What happened with the moratorium? People coming out of the moratorium, people are saying, well, they're all going to turn into foreclosures. We have a breakdown to where those people are right now, and most of them are paying their mortgage. So I think it's going to be a great class. We'll cover equity and how many people are in negative equity, because that's something that people talk about. I've already done much of the research there. We'll update it, but next week's deep dive is going to be unbelievable. So I'm really
awesome.
Excited.
Awesome. Thank you for that, Steve. Those were all the questions that we had ahead of time. But if you all have questions throughout Steve's presentation, go ahead and put them in there as comments so we can answer them at the end. Okay,
fair enough. Then we'll get started with today's. By the way, those are great questions. And one of the things I love most about doing the deep dive is we're talking to agents that really, they're coming here and spending a half hour of their life to learn something, learn more about something that's important in the market right now. And you're really on top of what's important, and we will keep you definitely informed. That's the whole purpose of the deep dive, is to go deep on a couple of issues. When we do the MMR, what we try to do is give you all the issues in a half hour, so you can know pretty much what's happening as we're going through. But the deep dive is for any issue that you want to. When you see it on a deep dive, we're going to go deep on that. And today's is going to be mortgage rates. But the essence of the deep dive is simple. Most agents know what's happening. Good agents understand what's happening. Great agents can explain what's happening. That's the whole purpose of the deep dive. We don't want you just know what's happening. You pretty much knew that coming in. We don't even want to just get you to understand what's happening. We want to make sure that when you're sitting at a kitchen table and listing presentation, or you're sitting in your office or in your car outside an open house, you can really explain what's happening in the market. Because if you can do that, very few agents can. If you could not just, talk about it, but truly explain what's taking place, you're going to build a trust, a confidence in who's ever sitting in front of you. All right. And that's the whole purpose behind the deep dives. And the reason I'm doing them, because I really, really love that deep understanding. So mortgage rates, where are they headed from here? Now, I want to start off by quoting Mark Fleming, because this is the greatest quote about people forecasting mortgage rates I've ever seen. The fallacy of economic forecasting is don't ever try and forecast interest rates, and or more specifically, if you're a real estate economist, mortgage rates, because you will always invariably be wrong. He is so right about that. No one really knows where mortgage rates are going. We're going to try to give you an understanding of what it looks like is going to take place. But ladies and gentlemen, if there's anyone telling you they know where mortgage rates are going over the next 90 days, 6 months, they're either lying to you or they're lying to themselves. It's probably the hardest thing in my 35 years in the real estate business, the hardest thing to nail down. And we do extensive work here trying to figure it out. All right, with our chief economist, George, with the whole research team. So let me give you what we do know about mortgage rates and where they may be heading as we move forward. First of all, I want to talk about the impact of mortgage rates on showing, sales, and prices. I want to take an historical look at it first. These are the times when mortgage rates went up at least 1%. Go to the increase column first, all right? And what you can see, nothing happened now. The mortgage rates doubled. So I'm not saying this is indicative of what's taking place right now. What I am telling you is the fact that it does have impact, and it's every single time. So if we look at home prices that just got highlighted in red, what we can see is every time mortgage rates went up, home prices went up. Well, Steve, that doesn't make sense. Well, yeah, it does in a way, because usually when does that happen? Usually mortgage rates go up. First of all, when mortgage rates up, what's the first thing buyers that are sitting on the fence do? They jump in before they go much higher. The second thing is usually a time where the economy is a little bit off. So some people might hold back some listing inventory. We'll talk about that in this market in a second. And that means that there's less supply while the demand increases. So of course, home prices will tick up. The last column is sales. And ladies and gentlemen, what do we know about that? Well, just like almost every other time, sales are down more dramatically. And we'll talk about that's because listings are down so dramatically. We'll get to that in a second. But I want you to remember, as I tell you, what winds up taking place is you're not a McDonald's, you're an Apple store. You have not lost one sale. If we take this market and make believe it's a snowstorm, well, in a snowstorm, if everyone's stuck in their house, McDonald's doesn't get that breakfast that day, they don't get that lunch that day, and they don't get that dinner that day. They lose that business because people still eat. But if you're an Apple store and somebody was thinking about buying an iPad, they don't, because the snow came, decide not to buy an iPad. They just decide not to buy it right now because of the snow. Once the snow melts and the roads are clear, they'll be at the Apple store. The Apple store doesn't lose one iPad sale. You're not going to lose one sale either. We just have to be patient and be ready when the floodgates open. Okay. Now let's take a look at the impact on mortgage rates on showings. So these are the showings from showing time. And the showings are staying strong. Now we can see that at the end of last year, as interest rates went up, showings went down. But we also have to realize normally toward the end of the year, showings go down. We have the spring buyer's market, and then we go into the summer, and then the sales go down from that point. So the showings, that's kind of seasonal. I'm not sure if it had anything to do with the mortgage rates, but that black line going through are the actual mortgage rates. I'll show that on a couple of slides. The orange bars on the bottom is the number, the showing index from showing time. But what we can see at the end there, it's still strong. Not as strong as it was at the beginning of last year, but the showings are still strong. And actually, they're stronger now than they were in 2018 and 2019. So the demand is still out there. People kind of adjusted. It got through the sticker shock of those high rates, and they're still out there buying. You already know that because you're in the market. But there are people that are in the news that are saying, well, there's no buyers out there. Well, that's just not true. 11,000 houses sold yesterday. 11,000 houses on average are going to sell today, and another 11,000 are going to sell tomorrow. Let's take a look at it on pending sales. Well, yeah, again, there's kind of a seasonality to pending sales, but what we can see is it didn't increase or decrease from September of last year. It remained pretty flat. So on the pending sales side, we've kind of maybe hit the bottom, and that will be existing home sales. We're not going to be going any lower, it doesn't appear, as long as we have the inventory to sell. So mortgage rates right now, it had some bearing on both the number of showings and, of course, on the number of people that, went to contract on a house, but it wasn't as dramatic as a lot of people would have thought. Now, some people are looking at this. Again, the black line is interest rates, and the green and red lines are home prices. And they'll say, well, as interest rates went up, home prices went down. Well, no, that's not the reason home prices went down. So if you looked at this graph, you might say, yeah, go ahead, that could be it. I would not use this graph because it's not really telling the truth. The reason the red bars existed at the end of last year is because the green bars at the beginning of last year were out of whack. We had unhealthy appreciation, which we covered in the last two deep dives. If you want a little bit more in depth on that, go back and look at those. All right. But what we had is unhealthy appreciation that caused depreciation. And now, starting this year, we're back to a more normal appreciation. I'm not sure mortgage rates had anything to do directly with prices, but it did have an impact on prices. Again, what are we saying? If we take a look at it, this is quarter over quarter. The first and second quarter of last year was crazy. There had to be a correction, and there was in the third and fourth quarter of last year. Some people were predicting we were going to lose 20%. Well, that didn't happen. And we're already back to appreciation again. And we'll keep you on track of that. But I'm not sure that, again, mortgage rates had anything to do with that. But this is where it did affect prices. Prices are affected by supply and demand. So what winds up taking place is the fact that if supply is low and demand is high, prices go up. Well, we know demand has been very resilient. The sticker shock is kind of over for a lot of people. There's an affordability issue, and with some deep dive further down the road, we'll talk about the affordability issue. There's definitely an affordability issue, but there are enough buyers out there right now that we don't have enough inventory to satisfy them. And mortgage rates had something to do with that. This is where new listings were headed right before interest rates started to skyrocket in the middle of last year. And what we can see, it was lower then, but it was following the normal trajectory of how listings go, the seasonality. And we compared it to 17, 18, and 19. So what we can see is it was going, and it actually, that block dotted line is where normally it breaks and starts going down. Later in the year, there's less new listings taken than at the beginning of the year. But because that shut up a little bit, some people were thinking we were going to have a tremendous increase in new listings. Mortgage rates went up. People were afraid it's going to be 2008 all over again. People were not advertising, but the headlines were saying prices were going to drop 20%. But in reality, this is what happened in new listings, ladies and gentlemen. The exact opposite. They were lower than they were in 17, 18, and 19. And we started out this year even lower than that. So for this July, we're still 28.8% off just last year. And last year was lower than the previous years. So what we're looking at right now, ladies and gentlemen, is a shortage of new listings coming to the market at a time when the buyers are still out there. We have anecdotal evidence from letting us know that many of your open houses is lines down the block. So and that anecdotal evidence helps us understand what's happening in the street from boots on the ground. But we also know that the number of offers per listing is turned and gone back up again. It was way high, it fell down, now it's turned again. Another indication, not anecdotal information, but data showing that there's not enough listings out there. And here's the reason why, ladies and gentlemen. 70.7% of mortgage rates are less than 4%. In this country, the people have mortgages. 70.7% have a mortgage rate of less than 4%. That's kind of crazy. And what does that lead to? Well, it leads to this. And I think I might have shown this last week too, because it applied. Lock-in rates, because rates are high now and they have a 4% or less, what's taking place is they're saying, if I have less than a 3% interest rate, I don't think I'm selling. Now, ladies and gentlemen, again, 11,000 houses sell a day. So I'm not saying no houses are going to sell. What I am saying here is that people that have a 3% mortgage rate, it's going to be real tough for them to sell a house. People that have between a 3 and 4%, they're probably not selling. It's hard to swallow that I'm going to give up a 4, 3.5, or 4% interest rate and take out a 7% interest rate with a new house. When you get up into the 4 to 5, well, they still have to think hard about it. Obviously, between 5 and 6, they're much closer and they're going to go. And if they're over 6, and I don't know how anyone has over 6% mortgage rate in the house with all the refinance availability over the last couple of years. And so I don't know why somebody would have an over 6% mortgage, but some people do, and they're definitely ready to go. They'll trade 6 to 7 because they want to make the move. Now, again, I'm not saying houses are not going to sell. Do not think I'm saying that. That is not true. What I'm saying is the fact that if it's something that people have to move with, young lady gets the job of her life, her dream job, but she has to move from Pittsburgh, Pennsylvania to San Francisco. She's selling a house in Pittsburgh. An older couple that lives in Chicago and is looking at the calendar and knowing the snow is coming, they don't want to really live through another snowy Chicago winter. He can't shovel the driveway like he used to, or she can, gee, hard helping. So what winds up taking place is they're looking to move down south. They will still make the move, most of them. So there'll be plenty of reasons, marriage, divorce, two people who decided that they don't love each other either anymore, maybe even hate each other now. They're not going to stay under the same roof because they have a 4% interest or mortgage rate. So houses are still going to sell, but the probabilities are less. So as when mortgage rates fall, this pie chart will change, and we'll let you know that. But this is a recent survey done by Flyhomes. 76% of the buyers who would need to sell their current home, who say they're reluctant to sell in today's market because they prefer to keep their current rates. So people might tell you, well, there's no such thing as mortgage rate like that, a lockdown. Well, according to this survey, 76% of the people that are thinking about moving and buying a new house are saying the thing that's holding them back, man, I got a low mortgage rate. I don't know if I want to get a high mortgage rate. Now, where's the line? Well, do we have to get back to 3 and 4? I don't know if we'll ever get back to 3 and 4. No. A new Zillow survey has identified the mortgage rate tipping point that makes homeowners more likely to move, which is key in unlocking the housing market and slowing price growth. Homeowners with a mortgage rate above 5% are nearly twice as likely to say they plan to sell their home than those paying a rate below 5%. So what we're seeing here is a big piece of the pie chart is going to become available once rates drop back into the 5s. And we'll talk about where rates are going in a second. But the first thing I want you to understand, the biggest impact mortgage rates had on home prices, it curtailed inventory at a time when the buyers were still coming out. So we had good demand, very low supply. Anything you're selling, if you have strong demand and low supply, prices go up. They're not going up crazy like they did last year, but they're still going up and will continue to go up. But here's an interesting graph. This is the quarterly survey of homeowner intentions and preferences. What we can see is every year it goes up, how many people are thinking about selling within the next 3 years, then it goes down, then it goes up, and it kind of zigzags, seesaws all the way through. But this year, it didn't go back down. It went up. 1 in 4 homeowners are considering selling within the next 3 years. Let's go back to the Apple store analogy. These are all the buyers that are about to come out. There's a pent-up buying demand from current homeowners. Current homeowners who are sitting on the fence, waiting for the interest rates to come down, the mortgage rates to come down a little bit. There's a pent-up demand. And when they do see them come down a little bit, that demand is going to be released. What are we talking about? Apple Store. The snow's melting. They cleared the roads. They can get to the store. They're buying the iPad. Now, Apple would be smart enough to know that, well, that day when the snow melts and they're clearing the roads, we got to have a couple of extra people on because we're going to have a bigger demand. The people who would normally buy that day, plus that pent-up demand coming. You're going to have the same challenge. Prepare for it. Not that far down the road. Be prepared for that those sellers that are coming out. Make sure you're in front of people that own houses now, because that when that thing clicks, it's going to click quick. It's going to be like a light switch. It's not going to be a dimmer switch. It's going to be like a light switch. Bam, they're out again. Okay. Two major reasons from the census: 66% cited a desire for an upgraded home with nicer features. And 45% said a growing family is influencing their decision to sell and move. All right, 66 want a nicer home. So two people are there, let's say, two spouses. One spouse is saying, we got a 4% interest rate, why would we move? And the other spouse is saying, of course, I hate this house. Now, there's a battle that's going on every day in that house. Who's ever more fiscally thinking is going to say, no, we can't sell, we can't. And the one who really hates the house is saying, I gotta move, whether you move with me or not. Secondly, 45% said a growing family is influencing. They might hold on a little bit if all of a sudden they have twins. All right, they might hold on a little bit. But eventually their lifestyle is going to be more important than the difference in rate. So I do think that eventually, just like we saw with the buyers, they kind of got over the sticker shock. I think a lot of the sellers are going to be coming over the sticker shock too. Now, that being said, where are mortgage rates headed? How quickly will they get there? Again, as I told you up front, nobody knows for sure. But what I do want to show you is what the projections are from the major forecasters for this information. Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors. If you look down the left-hand column, all the way to the left, it's the fourth quarter of this year, first quarter of next year, second quarter of next year, and the third quarter of next year. And we gave you what each one, the forecast, would go all the way to the right. That's the average of all three. So what they're saying is that mortgage rates are going to slowly, over the next several quarters, we're in quarter three now, over the next several quarters, mortgage rates are going to proceed downward. And remember, ladies and gentlemen, what's going to wind up taking place is once they get close to 6, we're going to see some people coming out, some sellers coming out to list a house. When that 5 is the first number, there's going to be a tsunami of sellers coming out to sell the house. We have to be ready for that, and these numbers might change quickly. The reason for the challenge, normally there's a 10-year treasury, that number is there, and then there's a spread above that. And for the last 50 years, that spread's been 1.72. It runs, the mortgage rates, the green line, runs directly with the 10-year treasury yield. Just add 1.72 and you're there. Well, that's not the case right now. If we had normal spread, that for the last 50 years, mortgage rate right now would be 5.82%. The blue bar is the 10-year treasury. The orange part of the bar is the spread. The spread right now is over 3. And that's what the challenge is. And ladies and gentlemen, that spread will come down. It's very unusual. Take a look at it. It's only happened since 1971. There's only 3 times that the spread hit 3%. Now, the good news is in all of the other, 4 times, including this time, and the other 3 times, it came down pretty dramatically. What causes the spread? The uncertainty in the market. People are not sure if there is a recession. If I give somebody a mortgage right now, they might not lose their job. If they lose their job, they're not going to make the mortgage payment. I got to put a little extra money in because I'm taking a little bit more of a chance. They're worried about whether or not, right now where mortgage companies might be laying people off and, past situations like this, the job market is still so tight. They're afraid if they laid off an underwriter or someone in the back office, they'll never get them back when this thing turns, and they know it's going to turn. So they're keeping on to employees that normally they might lay off for a period of time because they're afraid they're not going to get them back. And what has that done to profits? I don't have the 2023 numbers yet, but this is what happened in 2021. The independent mortgage banker's profit on each loan originated was a little over $2,000. In 2022, they lost $301. That's why 301. That's why the spread is bigger. They're losing money now and they're trying to make it up with the spread, which makes sense because they still have those expenses. Just like all of our expenses went up with inflation, all of their expenses went up with inflation. But once things settle out, I think we're going to be fine. And this is what's happening with inflation, ladies and gentlemen, right now. We hit the high point, the middle of last year, and it's coming down like a rock. All right, it's falling dramatically. That dotted line across is what Powell wants, Chairman Powell wants. He wants 2% inflation, not 2.1, 2. Now, some people are saying, hey, listen, we're close, and I think we are close, and I think that the adjustment in mortgage rates is close. But some people are saying, well, we're close enough, we're at 3. Why do we have to go to 2? Why do we have to go to 2? I want you to understand why. Ladies and gentlemen, the last time, the gray circle to the left, inflation shot up to 12.2. They raised the rate to drive it back down, just like they're doing right now. And when they thought they got comfortable, just north of 4, they let their foot off the gas. And look what happened. It shot right back up to 14.6. Chairman Powell's worried the same thing will happen. He doesn't want to take his foot off the gas until we're at 2%. Because he's afraid if he stops before 2%, it will kick right back up again. And why does he think that? Because that's what happened last. So when you're talking to your consumers, you don't have to explain these. You don't have to bring these charts out to your consumers, your buyers and sellers, but you have to understand what's happening. So you can talk to them with confidence, because if you talk to them with confidence, they'll have confidence in you. They'll trust you. Now, here's the real good news. The red lines is the funds rate. Fund rate's what Chairman Powell is doing, and that's affecting everything else. The orange line is inflation. What we can see, ladies and gentlemen, is that once inflation comes down, what always happens with the blue line? It comes down too. So what winds up taking place, almost it follows for the most part, all right, all the way across. That blue line, the Fed funds rate, will come down, hopefully to 0, and everything's going to be calm. And we can see we're headed in that direction. Well, I told you up front, we're not going to give you all the answers about mortgage rates, because nobody has all the answers about mortgage rates. But I hope we gave you enough understanding of how they impacted the market that you can intelligently and articulately explain it to your buyers and sellers. Again, I want to get into as deep as we got in here, but I need you to have that understanding. You have to understand it well enough that you can explain it to them. You don't have to understand it well enough to know it. You don't have to explain it or to understand it. You have to know it well enough to explain it. And that's what these deep dives are for. Ladies and gentlemen, this week coming out, this Thursday, the Keeping Current Matters monthly market report will be out, where we take a lot of the information we gave you over the last several weeks and put it in 1.5-hour presentation. Not a deep dive on each one of the issues, but maybe a way you can explain it to what's happening in the market to your clients. Next week, foreclosure crisis. What is really going to happen? A lot of great information. It's going to soothe a lot of people, and there's a lot of crazy headlines out there. We have to help. Again, what I said up front, most agents know what's happening. Good agents understand what's happening. Great agents can explain what's happening. And that is your responsibility, your moral obligation. And ladies and gentlemen, to help you with this, coming this Thursday on August 10th, you'll be able to download Clarifying the Confusion on Mortgage Rates. You have a responsibility to do that real talk. If you're a member and you have that that subscription to Has Real Talk, you have an obligation to get the word out. This is not just about you knowing it. It's about you explaining it to the public. You have an obligation to get it out. Please, ladies and gentlemen, everyone on this call that has Real Talk, please make that video. I know you're not the prettiest person in the world, maybe. I know that the camera scares you. I don't like the camera either. And as I said last week, I'm not Brad Pitt. I'm not, George Clooney. I'm not comfortable in front of the camera either. But this has to be done. And just like you're happy that I'm giving you this information and doing it, same thing here. That's what needs to take place. Now, to end this, I want to say this. When you're thinking about mortgage rates, realize only 3 things can happen. When you're talking to your clients, only 3 things can happen. They could stay the same, they could go up, they could go down. That's the only 3 things that can happen. And that video is going to explain that. It's going to be you talking to the public, explaining exactly that. Let's assume they go up. Well, thank God you bought now. If you're waiting for interest rates, well, let's look at the 3 options. If they go up, you're lucky you bought now before they went up. If they remain the same and you buy now, you're not hurt. There's no win or loss there. Well, what happens if they go down? Well, ladies and gentlemen, if they go down, then what winds up substantially? You refinance. At least you're getting a house at today's price. Only 3 things can happen. They go up, they go down, or they remain the same. And in either case, you're not going to get hurt if you purchase now. You have to get that information out. You have to do the Real Talk. If you're a member, just do the Real Talk. If you're not a member, just do me a favor and get that information out as much as you possibly can. I want to make sure that who can do those videos does do those videos. Right? Crucially important. Took a little bit more of your time. I'm over 2 minutes. I apologize for that. But ladies and gentlemen, I just want you to know we're making real progress as far as headlines are concerned, as far as the fear is concerned out there. We're clarifying a lot of things, and I really appreciate it. I appreciate all the agents out there that are not just sitting around and worrying. They're going out there and doing something about it. Appreciate it very much. See you next Monday, 11 o'clock Eastern, 8 o'clock Pacific, and we'll take a deep dive into the whole foreclosure situation, a real deep dive. Remember, don't bring your snorkeling equipment. Bring your scuba gear. We're going deep.